Good morning, good afternoon, good evening. My name is Will Goldthwait. I'm a portfolio strategist here at State Street Global Advisors, and today I'm going to try to give you a brief update on the LIBOR transition with a focus on cash bonds. So global authorities are proceeding with the LIBOR transition, but there are common issues. The Financial Conduct Authority is driving the transition off of LIBOR. But it's not going to announce the cessation of LIBOR without the LIBOR submitting bank's departure notices. So, and there's also been uneven liquidity developments in the new risk-free rates, right? We've heard a lot of volatility around the SOFR rate, and there's some other challenges in these new risk-free rates. Regionally, the UK is a leader. SONIA has the advantage given its long history and use for the discount curve for derivatives. In the US, the Alternative Reference Rate Committee, or ARC as it's referred to, has laid out a transition timetable, but market participants have not fully embraced this due to SOFR's lack of term structure, lack of credit sensitivity, and then, as mentioned, bouts of volatility. Euro will be focused on fallback language for Euribor. With Euribor existing indefinitely, there's less urgency around the end of Euro LIBOR. In June, Edwin Schooling Ladder of the FCA spoke to an audience suggesting the announcement about the discontinuation of LIBOR could come as early as November or December of this year. This is relevant for two reasons. First, the reality that there will be an announcement. And second, it could mark a date where ISDA recommended fallback language is triggered, and this would result in the spread to the risk-free rate. So in the case of the US, it would be LIBOR SOFR. In the case of sterling, it would be LIBOR SONIA is triggered. And that comes one year earlier than expected. Although the FCA has stated that due to the agreement they have with LIBOR panel banks to remain on the LIBOR panels until the end of 21, we don't expect LIBOR cessation or LIBOR to cease or become non-representative before the end of 21. So there's a little confusion there. The timing of an early announcement is important, just given is the protocol. And if it was announced this December or November, then that could include the year 2016. And now, if you recall, 2016 is when money fund reform went through in the US. And so that had a wider LIBOR SOFR spread, and ultimately would be, if included, as opposed to if it was December 2021, it would be excluded. And so that's worth about 3 basis points. So that could be a considerable sum of money. Sterling LIBOR SONIA has a similar result. So the UK is also considering legislation that would bolster the authority of the FCA over LIBOR, and this could help protect consumers, protect market integrity, sort of give the FCA that legislative authority perhaps that they need over markets. And it's very important to consider when thinking about the harder to manage legacy contracts or instruments that are tied to LIBOR. In the US has a similar situation. But just to go to the FCA again, they're definitely not trying to sort of push their will any more than they already have, because they are definitely seeking international cooperation in their efforts to affect this change. So the ARC recently proposed legislation to New York State to address LIBOR-based loans, and as we recognize, the vast majority of LIBOR-linked assets are governed by New York law. So this could be an important state if New York law actually hands down some process, procedure, protocol, et cetera, for those harder to manage legacy contracts issues, et cetera. As far as liquidity development, I talked a little bit about the challenges in SOFR. SONIA is certainly leading the pack with volumes. SONIA swaps outpace LIBOR swaps in the first 2 months of the year. Although the volumes did drop due to COVID, that increase in volume is encouraging. SOFR is having a harder time. The official sector enthusiasm has not been met with the same market volume increase by the private sector. So expectations are that the CME and the LCH will move from Fed funds to SOFR for discounting for cleared swaps in October. This should result in increased volumes. SOFR issuance in cash bonds has been dominated by the GSEs, or the government-sponsored entities, government agencies. Banks and corporates continue to prefer LIBOR. Thus, it may take a cessation of LIBOR to drive SOFR issuance. There is concern around developing a term market. It will be critical to see further derivative adoption in order to create this term market. And Ester in Europe, that functioning has been good. Underlying volumes have been increasing since inception. So, Andrew Bailey notes what was seen in March, and rightly so, noting this, what was seen in March of this year provides further evidence that the need to move away from LIBOR is critical. He noted that in the week of March 16th, there was no transaction data to support the setting of 3-month sterling LIBOR. And notably, the contrast to LIBOR to SONIA is that SONIA volumes rose during the same period. The Bank of England used SONIA as well as the reference rate for their COVID corporate financing facility that ended up holding $18 billion of commercial paper from 68 businesses. So they're really putting their money where their mouth is, so to speak. The U.S. ARC issued best practices to transition off of LIBOR. Fannie and Freddie have issued playbooks in the States. The ARC noted they would like to see hardwired fallback should be included in all issuance that matures after 21. The ARC timeline's pretty aggressive, perhaps as a way to further accelerate the move away from LIBOR. And government agencies have fully embraced SOFR issuance in the cash market. None have issued debt beyond 21 linked to LIBOR. And more important, we've seen a lot of issuance from them in SOFR. But the mortgage market's more complex, and that's going to take some time to work out, the adjustable rate mortgage market. So more work to be done there. Also, importantly, there's a credit-sensitive working group that was formed in early June. This is a New York Fed-sponsored working group that was formed to understand the needs of banks and their borrowers. The work is administrated separately from the ARC, but it's supported by the ARC. And the group will be challenged by limited underlying data, specifically through that period of March, as we talked about, as Andrew Bailey mentioned. Periods March through May, when the term volume was very low, and there really wasn't significant data to support a credit spread benchmark. So what have we been doing at SSGA? So at SSGA, we've been preparing for over 2 years. We've got a working group in place. The vast majority of our LIBOR exposures are in cash bonds. In fact, as of June 30th, we had a little less than $50 billion in exposures. And that's against a $3 trillion asset base at Global Advisors. Already we've seen LIBOR exposures drop by more than half since the beginning of 2019, so a good amount of work is being done. And if we did nothing between now and December 21st, we'd end up with about $8 billion of residual exposures. Now, of course, we're not going to do nothing. We're actively working to make sure that we have the appropriate exposures in those bonds that we own that have LIBOR exposures after 2021. But within this group that has formed at State Street Global Advisors to help transition us off, there's subgroups, and each subgroup has a task and task line, or tasks and a timeline that they need to complete. It includes information technology, market data, models, contracts, investments, public policy communication training, training modules being set up, metrics. So, you know, there are definitely some challenges. We've talked about some of the industry challenges. There's other challenges that face cash bonds, specifically market liquidity. You know, understanding exactly what fallback language pertains to each and every bond. Market supply, we've already noticed a significant reduction in floating rate note issuance. Issuers are tendering bonds, they're calling bonds, and they're just simply not issuing. So the other thing that we're keeping a close eye on is vendors. You know, will vendors be ready? Completeness of data, pricing, portfolio structure, portfolio construction. You know, will all of those vendors that we work with be ready? And so we're working very closely with those vendors to ensure that they are. The other group that we're working closely with is index providers. And making sure that those index providers are ready and prepared, and to ensure that we have good communication on whether bonds are falling out of an index or whether bonds will now be included in a different index. And so we're working closely with our index providers on that. And lastly, I'll just say we're working very closely with Bloomberg. We will be utilizing their fallback analytical tool. This is pending further development by Bloomberg, but it's expected to support 13 fallback elements and cover the global asset base. So we hope that will be very helpful for us. So there's still many unanswered questions and much work to be done, but there is a process in place here at State Street, and we will get things done. So I appreciate you tuning in, and of course, if you have any questions, please don't hesitate to reach out to your State Street representative. Thank you.